All right, how do you want to do this, man? Welcome back, Sean.
Thank you, Jerry.
I don't want to screw up your name because last time it was bad. And you should have seen all of the DMs that I got, the hate messages.
I can only imagine.
And I can't walk through this office while people call me Jimmy.
Now I'm known as Chad.
Chad.
Chad, not Chad.
You're the most controversial Chad since the hanging Chad in Florida. Is that Gore and Bush? That was a long time ago.
Wow.
Don't you do a lot of business in Florida?
I do.
All right, well, Chad Tadlawi, welcome back.
Thank you.
Why did I say welcome back? This is actually like very much feels like this is our thing.
Yeah. It's like we own this.
The last video I thought was really eye-opening. So what would you like to cover today?
So I wanted to actually follow up on what we did last time and do a little bit of a deeper dive and give people some examples so they can actually get a visual of what it looks like when I explain the process of taking credit card debt out and plugging them into their mortgage and reconfiguring the whole thing. Just a little preview about what I'm going to explain is if you have a mortgage and you're sitting on good equity, which most Americans do today, right, because of what happened over the last 3-4 years. If you have equity,
yeah,
and somehow you're fallen into that trap of feeling comfortable and just spending, and somehow you're not able to catch up with your credit card debt or your other debts, whether it's student loans or if you took out a HELOC and the rate has changed on you, so the payment has jumped on you and so on and so forth. There is a way you can take all your debt, consolidate it into your mortgage, and have one simple payment that's probably going to be a lot cheaper than what you're paying on everything separate.
What that's interesting. What type of debts can you consolidate?
Anything you have. Anything that can be paid off. So if it's credit cards, you can pay off the credit cards. You don't necessarily have to close the accounts, but you basically are at zero balance. If you have a car loan, you can pay that off. If you have a car lease, not so much. I mean, you can, but you still have to return the car at the end of 3 years unless you like switch it from a lease to an ownership and then pay it off. Right?
So how do I know if debt consolidation is right for me?
The best way is to do a consultation because every person's specific needs are going to be different from one person to another, right?
Got it.
And I'll be that vessel for you. We're going to talk. We're going to lay down the different options, and I'll guide you towards what's better for you. And then you make a decision at that point.
So what would you say are the different options when consolidating my debt? Or are you going to show me kind of the new thing right now?
So there is different ways. You can take out a loan, right? And then, like, if you don't own a house, right? If you don't have equity, if you don't have a mortgage, you can try to take out a personal loan at somewhat of a lower interest and then lump everything into it and then just pay on that loan by itself, right? That's also an option. But if you have a mortgage and you have equity in your home, you're better off doing it in your mortgage.
Got it. Okay. So you're saying that we could lump all of that in together, use the equity in our home to pay down that debt or pay off that debt?
Completely kill it.
So you kill it. So say, can we still use our credit cards though if we do that?
Absolutely. Yeah, absolutely. I mean, it's a rinse and repeat.
Right.
If you put yourself in that trap again, eventually you're going to run out of equity.
Right. That's a good point.
So it's something that you need to review with a professional, and you need to come up with a plan and stick to the plan. Right?
Are there like different fees and stuff associated with that? Like depending on what kind of debt you're bringing into it, or
no. It's a refinance is refinance. There is costs associated with doing the refinance. Right?
Got it. Okay.
Whether it's a cash out, whether it's a rate in term or whatever else. Right.
Okay.
The cost is minimal in comparison to what you gain in the long run.
Okay.
So let's dive into it because
sure.
I have an example that I'm gonna show the audience, right? And it's up here on the screen where I have this fictitious client, right? He's not really fictitious. It's a real person that I've helped.
Okay, we won't name any names.
Yeah, no
Jimmy.
names because It's Chad.
It's Chad. No, Chad's debt free.
Yeah.
Jimmy's in trouble.
Jimmy's in trouble. Okay. So Jimmy bought this house back in 2012. So Jimmy bought a house back in 2012, bought it fairly inexpensive because he's in Florida, bought it for 155. He did a refi not too long ago in 2020 when the refi boom was happening, and was able to reduce his interest rate down to 2.375. Right, this is very, very low. So this client was very, very reluctant to refinance a mortgage at 2.375. But when I broke down the numbers and I showed him what it would look like, it actually made sense, and he went ahead and did the refi debt consolidation. Right?
Can you give me an idea? Okay, so he's paying 2.375 on his mortgage.
Correct.
But where was he in terms of interest on his credit cards?
So this very clever person managed to rack up about $50,000 worth of credit card debt that basically took the interest from whatever it was a few years back to now about 30% average between all of them. I think one of them was 27, one was 29,
Wow.
and one was 28%, right?
Okay.
And he's also carrying student loans in the magnitude of about $60,000.
That doesn't seem. It's a significant amount of debt for student loans. What would you say like is the average American student loan debt?
I mean, without really lumping doctors into the mix,
I see. Yeah,
it's probably around $100,000.
$100,000. And then what are they paying typically on average in interest rate, depending on credit or?
The student loans have somewhat lower interest in comparison to other debts. If it's undergrad, they're probably around 5 or 6. If it's graduate, they're close to 10.
Got it.
So they're a little bit higher.
It's still a significant amount of debt that you're carrying.
Correct.
Got it.
Correct. So we all know that most of the federal student loans right now are on deferral, but that's going to end very soon, right? So he decided to add his student loans to this whole calculation to see how much relief he's going to be able to get overall, right?
Got it.
He also has a car that he was paying about $700 a month on, and in his zealous process, he took out a home equity line of credit, right? Okay, so all in all, he racked up $195,000 worth of debt, and the payment on that debt alone, not including his mortgage, was $3,000 a month.
Wow.
So in addition to the mortgage that he was paying on, which the mortgage at 2.375 was only $875, right? Which is pretty low. And I will show that here, right here. So in the
It just doesn't seem fair. I mean, you're just like forever paying into this pit. Like you're just scratching the surface every time you make a payment.
At 30%, absolutely. It's insane. It's a lot of debt. I mean, all the money that you're sending is going towards interest.
Yeah.
You're barely
It's just this
scratching the
vicious
principal.
cycle though. Like
It is. It is a vicious cycle. So from his current principal and interest, plus the $3,000 payment that he was adding on in his credit cards, I came up with a way to show him that it's actually beneficial for him to move from a 2.375 interest rate to a 7.5, which is today's market for a loan of that magnitude, right? So this little screen shows us so if he just did a rate and term refinance, basically taking his current mortgage from 2.375 to a 7.5%, he would be making a payment that's $641 higher than what his current situation is, right? Mm-hmm. So that's the difference between the two mortgages. Now, start putting in the debts, the credit cards, and I'll do it one by one so you see the monthly payment change from a deficit to a gain. So just by taking one credit card out of the equation, right, the monthly deficit drops from $641 to just $180. Add the second credit card. Now we're starting to save.
Yeah, now you're back in the green.
Back in the green.
We like the green.
Yes, the green is good.
Green is good.
3 credit cards, and you're making some money. Now, I'm just going to jump and do all of them. So, if you take the $195,000 and add it to your mortgage, you're going to get a relief of $1,000 every month.
Wow. And now your debt is at zero.
Debt is at zero. You have no student loans. You have no equity line of credit. You have no car payment.
Let me ask you a question. What are the risks that are involved when you do combine the two, your credit card debt and your mortgage payments?
There is no risk because now that you don't have credit card debt anymore.
So what if you miss a mortgage payment?
I mean, if you miss a mortgage payment, it's
the same. It's bad.
You don't do that. You just
don't do that.
Yeah, you just don't.
Yeah.
But the difference here is instead of paying $3,000 plus the mortgage, you're only paying the mortgage.
Got it.
And you have an extra $1,000 that if you're comfortable paying that money, you can take that $1,000 and put it towards your principal. Right?
Oh, that's a move.
Yeah. So this is like a ninja move, right? So let's say you're okay with paying $3,000 for your credit cards and your other debt, right?
Right.
And you're okay paying your $1,000 in your mortgage.
Right.
Right. So you're comfortable with a $4,000 expense, right? Now, just for the sake of rounding numbers, your mortgage payment is $3,000 and you have an extra $1,000 that it's either going to your savings or going to whatever else you want to use it for.
Right.
Or you can take that $1,000 and put it towards your principal. And let me show you what that's going to do. Instead of writing the new mortgage for 30 years, you're going to knock that mortgage in 14 years and 4 months.
Wow.
You're going to slash your mortgage in half.
And kill your debt
Done.
at the same time.
You're done. You have no more mortgage payment. You still have your house. And you have no debt.
So why aren't we hearing more about this and why aren't more people doing it?
Because if you don't come across the right person, they're not going to know how to explain it.
It sounds too good to be true.
Right.
I'm drowning in credit card debt, 30% interest.
Mm-hmm.
I'm just paying the minimum payment.
Yeah.
Which it's still accumulating, and I'm not even tackling that stuff.
That's correct.
Losing sleep overnight because I've got a mortgage that I'm also paying, and most people will get fixated on that 2.5% that they have in their mortgage, and they don't want to mess that up. But meanwhile, they're paying that 30%.
Absolutely.
So what is the average that you're seeing when you do combine the two?
Mm-hmm.
So what did that go up to? 7.5%?
Correct.
Which by today's standards isn't terrible.
No, it's no. I mean, the norm in interest rate in the United States hovers around 5.
5.
Right. That's
This is a new thing.
Yeah.
Right? Wait, how long ago were we in double digits?
I remember it.
Yeah, no, it's our lifetime. It's not
is.
that long ago.
It's not that
we
long.
just got very comfortable with free money.
I know. So the fact that because of the pandemic, we reached the very low interest rate of 1%, 2%, and 3%.
Yeah.
It set a new standard, but that standard is really not real.
We hear it all the time. People are casually throwing out this low interest rate when I it wasn't that long ago that it was double that, and that seemed normal. 9% seemed normal. Yeah. And so we're fixated in recent memory with this low interest rate. Meanwhile, we're just racking up more and more debt, and it almost feels like the credit card companies at liberty or increasing the interest rate. It's just I look at my bill and I'm like, when did that happen? Like,
Yeah.
does that happen? Like, are they?
It's normal. It's normal. So your revolving credit follows the Fed rates,
I see.
right? So when the Fed rate goes up, your short-term short-term rates go up with it.
Okay.
That's
Okay.
why at the same time as your credit card rates are hitting the 30% range,
Yeah.
you're also noticing that your savings returns on your savings accounts are slowly going up.
I haven't seen that. But when you say slowly, not at the rate that the other ones are going up. Yeah.
So my personal example is I have a high yield savings account.
Right.
We can go into what a high yield savings account later, but when the credit cards were at 14%, the high yield savings account was at like 0.75% or 1%. Today, it's about 4%.
Okay.
Okay, so it went up because the Fed rates went up with it.
Got
Right?
it.
So the Fed rates affect the whole financial system different ways, right? So the credit cards go way up, the savings go up slightly, because financial institutions need to make money.
Yeah. What do you need to qualify for something like this? What is it that will make me eligible to consolidate this debt in the way that you're describing?
Honestly, every person is different. Every person's situation is different. So the best way to figure out if you're eligible for something like this is to just have a conversation.
Yeah.
Right.
The scariest part is to have a conversation.
I know.
We covered that last time. I was just like, oh,
yeah. Yeah, you have to be able to just be like, okay, bite the bullet. I need to talk to somebody. I need a way out. And you never know. I mean, the way out could be so easy.
Yeah. Yeah.
And you will feel such a relief once you know that you have a solution to your problem and you actually implement that solution.
What is someone bringing you? Like, I'm going to go home and I'm going to try to figure out like what's and how. What do you need to look at to understand how to help someone?
The easiest way for me to get a macro perspective on everything, I need a mortgage statement to know how much equity you have. And I need to look at your credit report because that will give me every little line of debt that you have that I can see what I can basically pay off from your accounts and lump into your mortgage.
Got it.
It's very simple.
Yeah.
It's a simple process. It'll take me maybe a day to come out with a solution. So, I mean, the one thing that I would recommend people doing is schedule a time with me, right? Let's start with having a conversation and see if it makes sense. If we see that there is a way forward, I can go to the next step and have you do an application and evaluate things in detail. Once I do that, then I can come back to you. We'll do a one-on-one meeting, and I'll show you exactly what can be done, how it's going to affect your finances altogether, and what you can qualify for.
Do you, let me ask this. I mean, I guess it depends on the situation, but like what kind of questions do you typically ask in your first meeting?
Well, okay, so this is, I'm going to sound like a collection agency. This is an attempt to collect the debt. No, it's not. No, the question is simple. How much do you make? Can you qualify for a mortgage? Can you afford to take on a larger mortgage and seek that relief from debt, right?
As a real estate professional, income changes all the time.
Right.
And real estate agents can write off a tremendous amount. They could report no income.
Right.
So does it, how much of a factor is that? I see your proof of income maybe showing the last couple of years of your tax statements.
I'm so glad you brought that up because as a mortgage broker, I shop 190 different banks.
Okay.
190 different lenders.
Okay.
Each one of those 190 plus lenders have their own niche product that they excel in.
I understand.
So that being said, not everybody has a paycheck and a W-2.
Right. You're in LA, like you're in Hollywood. Like
Yeah,
we have
exactly.
producers, writers, actresses, all kinds of stuff.
So I have a program for everybody.
Okay.
I have a program for the self-employed entrepreneur, 1099, right? You're 1 month you make 50 grand, the next month you make 100,
Right.
right? And maybe
None.
none the following month, right? So I have a set of lenders that will work specifically with an individual like this, right?
Got it.
There is business owners that rely on their business income to do everything, meaning all the expenses go through the company, all the income goes to the company. I have a bank statement solution that I can offer these individuals. Basically, it's an evaluation of their deposits over the last 12 months and an average of that to come up with the income figure to use for a mortgage application.
Basically, what this is saying to me is real estate's a good investment. So, what if once I clear off all of my debt, I still have some leftover equity. I'm getting this extra $1,000 a month. I realize maybe I can come up with a down payment for another home. Can you purchase another home after you've done this debt consolidation?
Absolutely.
You can.
Because let's do a quick deep dive of this scenario. What happens when you rack up debt? What happens to your credit score?
It takes a dive.
It takes a dive.
Yeah.
So somebody with that much debt is probably hovering around the low 600, assuming that they've been making their minimum payments on time, right?
Right.
Typically speaking, when somebody's drowning, they tend to become late. They have issues. It basically snowballs, right? So when they have a low score, it becomes even more difficult for them to come out.
Correct.
Just because they start not being able to qualify for things.
Right.
Right. So it's better to tackle this early on when your score is still not affected.
I see.
Right.
Right.
So because
Does this impact your score?
this will solve your score problem.
It'll solve the problem.
Yeah.
Because it's wiping out that
Yeah.
debt.
Once you pay off the debt, your score is going to shoot right back up.
Interesting.
And the beauty of all this, if you, after going through this program, right, you do the refi cash out, you do the debt consolidation, you wipe out your debt, and you become more aware of what you've done, and you stay the course of staying debt free. The next time that the rates drop, you can do a rate and term refi, reduce your interest rate, and just stay the course.
That's interesting. So you're not even locked into this rate forever. You actually get the opportunity in the event that you can reduce that rate.
Absolutely.
And it's called what again?
It's a rate and term refinance.
I got to imagine that feeling that you have that once you've paid this stuff off, you got a clean slate. You want to kind of keep it that way. And it just motivates you to clean up a lot of other things going on in your life.
Absolutely. And that's the trend that happens with people that do this. It's 90% of the people will stay the course, they'll stay debt free, and they'll basically now turn that extra cash into another investment that's going to make them more money.
What about for the people that just don't know that stuff? That just would typically fall into the trap of getting into debt just all over again. Do you have tools to kind of keep them off, like some guardrails, or is it?
I mean, it's really hard because once you pay off the debt, I mean, it's a clean slate.
Yeah.
It all the doors reopen to you.
Right.
So if you don't have self-control and self-discipline, you're going to fall into the same trap again.
But if you're asking these questions, you must be able to recognize that there's an issue.
Of course.
Yeah.
Of course.
I see. Yeah.
So I have coaching sessions that I do with people. I'll be like, hey, talk to me about what you're planning to do, and let's see if this makes sense or not. And I welcome you to do that with me as well. Yeah. So we'll evaluate things periodically, maybe once every 90 days, once every 180 days or whatnot, and decide if, this little impulse purchase makes sense or not. This gives me an idea. Maybe I should create like a hotline, like a impulse purchase hotline.
You'd be a busy guy.
I know, man. It's like the phone be ringing off the hook.
Busy guy. All right. Well, this is super enlightening. what are the 3 big takeaways that you want people to walk away with after this conversation?
So the first thing that you need to do is have the courage to have a conversation, right? Pick up the phone, give me a call, go on my website. If you're too shy to give me a call, go on my website, shauntad.com, SHAUNTAD.com, and drop me a line. I'll call you, right? If you want to text me, email me, that's all available. Don't be shy. Talk to me. I will help you.
Look, ladies and gentlemen, anybody out there listening to this thing, I'm sitting across from him, smart and lovable. So like don't be intimidated by the debt. He's not the debt monster. He's the guy that's going to come in and help you fix it.
Absolutely.
Yeah. All right, cool.
I am the fixer.
You're the fixer. God, it almost sounds too good to be true. But if you're sitting on some equity, don't sit on it. Let it help you fix your problems.
Yep, absolutely.
That's cool.
Make it work for you.
Make it work for you. All right. Anything else you want to cover?
That's it. I mean, social media at shauntad.com or at shauntad.
Where do they find you? At Chad Jimmy.
I take smoke signals too.
You send a courier. Remember that time that courier pigeon came? All right, listen, buddy. I love you. I always learn something new from you. I appreciate the time.
Thank you very much.
All right. Till next one.
It's a wrap.
See ya.